Hi everyone, this is Jason Biarco of Wall Street from Main Street. I'm just going to do another short video today. I'm not going to do them all the time, but when I see current events that interest me or anger me or I think are pertinent to you guys, my listeners, I'm trying to help you learn about investing in the economy to either improve your returns or for knowledge and education purposes. I will do a short video to comment on them. This news story caught my eye today. Yahoo released it. It's a PR statement from the Federal Reserve. U.S. Fed adopts bankroll to prevent government bailouts. Okay, so let's read some of it. I will attach a link for you guys to read the rest of it. It says, today, the U.S. Federal Reserve adopted one of the final banking reform steps following the 2008 financial crisis, which aims to prevent government bailouts of major banks. The new rule requires U.S. and foreign systemically important banks, those deemed too big to fail, to issue a minimum amount of long-term debt, which could be converted to equity to shore up the bank in the event of a bankruptcy. In addition, the rule increases the required capital cushion known as total loss absorbing capacity. The Fed estimates there is a combined shortfall of about $70 billion for this kind of debt and capital. Only $70 billion, eh, guys? That's interesting. Deutsche Bank is probably would need at least $70 billion all by itself in the near future. So Deutsche Bank probably needs total in order to delay like bankruptcy or it being partially nationalized. More than an order of magnitude larger than that 70 billion number. So for them to only say it estimates at 70 billion total in bailout money for too big to fail banks, so they don't need bailouts anymore, that's all they need to raise, is totally ridiculous. I can't believe they even, this is total propaganda that they put out. I guess it's to assure people, get them maybe bank stocks to go up a little bit, a little pop here. So some of these bank stocks, maybe European bank ones, can start selling some more equity in the near future, maybe get a 10-15% pop back in the bank stock so they can sell more. The U.S. banks were more recapitalized after the 2008 financial crisis. I mean, they still have huge derivatives exposure. It's just they weren't, unlike the European banks, which weren't capitalized at all, the U.S. ones were actually capitalized more, thanks to the U.S. taxpayer and equity raises and other stuff. And also, the accounting rules were suspended. So let's give a brief overview of some of these. This thing is ridiculous. So they're basically saying that the too big to fail banks don't really need that much capital anymore, only 70 billion, which is ridiculous. I think, what's hidden in here in this press release is about the them selling long-term debt and equity. Well, most people aren't going to buy that. So who are they going to force to buy it? It's going to be a covert, probably backdoor bailout by central banks again, or the IMF, either creating newly printed currency via currency swaps or some other type of liquidity program, perhaps the SDR if the globalist and New World Order people get their way. Or maybe, they go after the large chunk, over 19 trillion of retirement money and force you for national security purposes to not only hold maybe U.S. treasuries, you also have to, for national security purposes, own either some bank stocks or some banks or some bank debt. Maybe, 1 or 2% to start off with. This is how they like to layer things on. This is how the central planners, these evil, immoral central planners like to layer things on. So this PR is just ridiculous, saying that the banks only need 70 billion for this kind of debt. The Federal Reserve's long-term track record, guys, whether it's the Greenspan Fed, the Bernanke Fed, their long-term track record of predictions and accuracy of those, and their economic models are totally broken. Their long-term predictions are almost always totally wrong. I was arguing with someone on Twitter. He said that they're doing this intentional. I don't think they're doing this intentional. I just think, they are blind ideology. They believe in their models. They believe in certain principles, whether it's, the mainstream media dealing with that their point of view is always right. And, if you have a different point of view in the independent media or alternative media, then you're wrong. I think, there's a lot of people like that. And it's turned into a bad religion. And some people, their religion is their economic models. So their models say this and their models say that. This is why people, the people in power, the banks with their variable at-risk models, always put in that, real estate prices couldn't fall. So let's talk about some of the other things that are catching my eye. The Dow now is almost up to 20,000. Harry Dent actually said that the Dow would get to 30,000 by 2006. He totally missed the 2008 crash. Then after the 2008 crash occurred, he came out with another book called Collapse, saying that the collapse would go even lower. So he's missed this rally too, at least publicly. Maybe in his newsletter, he's saying the exact opposite, but his marketing materials and the other main comments he's put out are saying, that basically whenever gold and silver goes down, he's predicting more of a collapse. He's predicting asset price collapses and big deflation. I don't think the central bankers and the people in power will allow deflation for a long period of time. The thing is, with these debt-based fiat currencies, they have to devalue it. So this gets me into one of my next points here, and this is the strong dollar. Really, since Trump has won the election, we started to see the dollar strengthen. There's obviously been other reasons why the dollar has strengthened, but a strong dollar is very dangerous. We've seen the asset markets hold up pretty good with a strong dollar. The stock market is up. The gold price is obviously down with a stronger dollar. But this may signal a stronger dollar, may also, besides the Federal Reserve just raising interest rates yesterday again, may also signal the end of the 35-year bond bull market. We have professional investors who are billionaires, Stanley Druckenmiller and Jeff Gundlach, saying that the 10-year Treasury note will get to 6%. I don't think it will get to 6%. Even if there's a panic, I think there'll be some type of intervention. But, maybe it will. But that would cause an enormous amount of pain. I don't think the U.S. government can pay 6% interest rates at this point. It just can't afford it. So, we've had financial repression. This interest rate increase was a token. I did the video yesterday about the interest rate increase, how it was a token interest rate increase to maintain credibility. And that, the Federal Reserve is promising that they're going to do 3 interest rate increases in 2017. The odds of that are very low unless they intentionally want to crash it on Trump. Okay, so we have a strong, the dollar and the dollar index has been having a big rally lately. It can do an enormous amount of damage. I pulled up this article. It's from last month from Bloomberg, and it's saying how there's over $3.5 trillion in non-bank foreign corporation dollar-denominated debt. Over 3.5 trillion. I'll let you guys read that. That's in addition to the trillions of dollars in foreign government dollar-denominated debt. So I've seen estimates of over $8 trillion in emerging markets, either with foreign governments, banks, and foreign corporations of dollar-denominated debt. And when their currencies are getting weak and the dollar is getting strong, that may temporarily boost exports, but it's not going to help them pay off their debts. In real terms, that's going to make their debt more onerous to pay off when they have to pay off the debt in a stronger currency. So their local currency is weak, and the debt that they owe the currency that they owe their debt in is strong. So that's not good for them. They were hoping the dollar would be weak and their own local currencies would be strong, and it would be easier for them to pay off the debt. But these are the dangers, though, about, taking out a lot of dollar-denominated debt. The U.S. has basically got people hooked like a drug dealer, giving out these artificially cheap dollar-denominated debt the banks and U.S. government have to entice people. So, how a drug dealer will sometimes give out free samples of their drugs, hoping to find new junkies that will keep paying whatever price and hawk, their assets in order to afford more drugs. So I think, this is the case. We've gotten people addicted to cheap dollar-denominated debt, and when the dollar has risen, it can do a lot of damage. So the central bankers, we've heard, Robert Rubin in the past, who was a former Treasury Secretary, talk about a strong dollar policy. No central banker in any country wants a strong currency. Japan does not want a strong yen. The European Central Bank does not want a strong euro. The U.S. Federal Reserve and U.S. Treasury do not want a strong dollar. They will come out in public and maybe say that, but what they really want, and this has to do with the nature of debt-based fiat currencies, these things have to be created, more units of them, and they have to be devalued. What they want, though, is they want a controlled devaluation. So they want to gradually devalue these things, maybe 5 to 9% per year, or somewhere along that range, so hardly anyone notices that their purchasing power is being stolen, so that the status quo can continue, more of crazy spending projects and other, political bribes and things can be afforded and spent, and the people in power can continue to siphon off and redistribute and redirect more wealth to key groups, to themselves, and to key groups to buy votes and other things. So, the asset prices right now, we have stock market at Dow 20K. It's ridiculous. We have utility stocks right now with really no future revenue growth. People are desperate, chasing for income and yield. They're willing to pay over 20 times earnings for utility stocks. In the past, normally, utility stocks would sell for about half. but we have a lot of people who have to put money to work either in mutual fund managers or hedge fund managers who are value oriented or other value oriented managers. And we also have, the latest numbers that a lot of people are chasing the higher stock market. These are the same people probably that chased real estate in 2006 and 2007, that chased technology stocks in 1998, 1999, part of 2000 before it collapsed. So, that's the herd. This is the herd mentality. It's very, very dangerous. Yeah, so I've talked about, okay, let me just check my notes real quick. How much damage can a strong US dollar do? So I don't think the Federal Reserve, if the US dollar and the dollar index continues to strengthen, it could cause a lot of problems, not just with asset markets, but with actual, collapse potentially of emerging markets that can't pay their dollar denominated debt. We know Brazil had tremendous problems a little bit ago, that they were in major jeopardy. Oil has had a rally, so that has helped them a little bit. If the oil price goes lower and the Brazilian real continues to stay low against the dollar, that will cause the Brazilian government tremendous problems. There's also corruption there as well. So this is very interesting times we live in now. Things are going to get very interesting. We've had the gold and silver markets knocked down, whether some of that's manipulation or not. Or whether it's the high frequency trading computers are just trading off, strong dollar weak gold. Obviously, that could play into it. But the news of Deutsche Bank with the gold and silver manipulation and, providing more evidence, like I said, in the short term, it's not going to knock the price a lot higher. I saw an article on King World News saying that silver could go to 1,000 now. I don't know what type of time frame they gave. But, in the short term, that stuff, even silver to 50 in the short term is kind of ridiculous. So don't expect to see silver at 50 in the next couple months. I've said in public interviews before, in 5 years, we could see silver at 50. We now have silver breaking key support levels, gold breaking key support levels at 1150. We're now at a point where the gold and silver miners are going to really be panicking, primary gold and silver miners. So they have cut costs to the bone the last few years. When the gold and silver had their rally, they did not bring on a lot of new mines. They were very cautious. They did go to the market earlier in 2016 and raise equity. They were heavily criticized for it. People thought, why are you going back and raising equity? Well, their balance sheets weren't good. And they were worried that, if there was a correction in gold and silver, they were still worried about their balance sheets. So I think we're going to have a situation, guys, where, if gold and silver are capped for a little while in the short term, we could have the mines put back on care and maintenance. We could be in that danger zone again. The only way to know this for sure, though, is to actually look at the financials of the mining companies. That's going to come out in the next couple months for the next quarter. Listen to the guidance that the mining company CEOs have in the conference calls. So if you're really into that stuff, you can listen to the conference calls for some of the gold and silver miners. I know, though, for a fact that the big five royalty and streaming companies like Franco-Nevada, Silver Wheaton, Royal Gold, Osisko Gold Royalty, and my favorite, Sandstorm Gold, the phone is ringing off the hook the last month or two now. The deals that were not there, the quality of deals that were not there on either assets that are already producing or assets about to go into production, the quality of those deals that were not available earlier in the year because equity could be raised, mining companies could get some debt, the ability of equity and debt now that the gold and silver have had a huge correction, those are not available, and companies are now looking at royalty and streaming financing again. So long term, the royalty and streaming companies who have diversified sources of cash flow, solid balance sheets, generating free cash flow now, even at these lower metals prices than we had a couple months ago, they're going to do smart long-term deals for the most part. So I would be looking to accumulate those if you're a longer-term investor on dips, on weakness, not just Sandstorm Gold, obviously. I think Silver Wheaton, besides Sandstorm Gold, I think Silver Wheaton's the most undervalued of the bunch. Silver Wheaton, because you get a lot of upside exposure to silver, you also have a lot of cash flow from Silver Wheaton, and Silver Wheaton has enough free cash flow where they can afford, dividend increases once the silver price rises, and also share buybacks in the future. So they're just a very large silver streaming company. They're the largest of all the big five. Yeah. So what do you guys think, though? Do you think the Federal Reserve is actually intentionally trying to have a strong dollar? Do you think that this is a backfire of their plan? Look at the track record, though, of the Alan Greenspan Federal Reserve and the Ben Bernanke Federal Reserve. That's what I would point to, though, for those of you saying that this is intentional and all part of the Federal Reserve's plan. I mean, the track record of predictions that these guys make when they come out in public and say things, or with their economic models and white papers that they post, the track record of these guys inside the Federal Reserve is just horrible. If these guys were working for a private sector company, they probably already would have been fired after a year or two of, these just horrible predictions that have been totally wrong. Okay, well, that's it for today, guys. I just wanted to talk about this, mainly this PR article that was put out about the too big to fail banks and how they only need $70 billion in capital. It's kind of ridiculous. I think, this is just setting it up for more like I've been talking about in many videos and many interviews in the recent past about how central banks for their future bailouts are going to go more covert than overt, because people, if they announce overt QE programs, overt bank bailouts, people would potentially come out with the pitchforks. It's just a lot easier to do covert backdoor bailout, currency swap deals, or the IMF can issue, these SDR liquidity programs that are coming. And the really scary part about all this that even most financial professionals are not aware of is that these central banks don't even have to list their currency swaps on their balance sheet. Not that they're getting audited anyway, but the stuff that they put out in public with their financial statements, they barely list, any currency swaps at all. So we need to have all of our central banks publicly audited by independent entities, and then we need to start working on plans to reduce the central banks and eliminate them, because they are causing really bad moral hazard. They are destroying our purchasing power and savings by intentionally devaluing currencies. And they are allowing, these evil politicians like Hillary Clinton and others to bribe the public with their own money and gain way too much power over all of us, and allow, the mainstream media, a lot of these guys don't even make profits in the mainstream media anymore, to continue to brainwash lots of people in the public with this fake news propaganda. Okay, well, that's it. That's it for today, guys. Oh, I found out one last thing. There's this deplorable, which is supposed to be the day before inauguration in Northern Virginia, Washington, D.C. So anyone who doesn't like Hillary Clinton, whether you voted for Donald Trump or you're libertarian, maybe you voted for Donald Trump and you're still libertarian, or you're just libertarian and hate Hillary Clinton, there's going to be a lot of famous people there from YouTube and Twitter at the deplorable. It was supposed to be locally to me around the Clarendon Ballroom, but a bunch of crazy Hillary bots started emailing and calling and tweeting the Clarendon Ballroom, and they got the deplorable moved. So I may go there if you want to meet me in person. I'm hoping to meet a cute libertarian girl there and speak to her. But, I'll hang out with you guys for a little bit, and we can talk shop about the economy and maybe what's planned next. It looks like, the Clintons are not giving up. They're still trying to figure out ways to steal the election. And, they have their minions stopping any celebration like the deplorable. But I think they will find a venue, and I'm hoping to be able to go. Okay, bye, guys. Hi, everyone. It's Jason Burek of Wall Street for Main Street. Thanks again for tuning into our podcast and for helping us get over 2 million views on our YouTube channel and over 10,000 iTunes downloads per month. We have a special offer for our Wall Street for Main Street listeners that has proven to be a good investment based on plenty of 5-star reviews from satisfied customers and independent fashion bloggers. Mo and I recently tried some shoes from a new company which is run by a family of third-generation shoemakers called Grant Stone Shoes. These are classic Goodyear welt shoes using full-grain leathers from world-renowned tanneries. In a world filled with disposable products, it can be difficult to find items which can be used for years and later passed down to the next generation. Grant Stone is a smaller brand going direct to the consumer, which offers unprecedented value. Quality and fit is the cornerstone of their program, and the customer response and reviews confirm this. These are high-quality shoes at a good price for the busy professional who wants to improve their appearance at the office, in the boardroom, or out on the town with your girlfriend or wife. Or, if you're single like me, you know you will look good with these shoes on and maybe impress the ladies with your style and taste. But, if the ladies love Obama or Hillary Clinton or Bernie Sanders and hate free markets or capitalism or entrepreneurs, at least I will look and feel good in my comfy Grant Stone shoes. Mo and I have worked out a special offer for our listeners. So when you go to grantstoneshoes.com, enter the code GOLD, that's GOLD, for 10% off any purchase. That's grantstoneshoes.com and enter promo code GOLD.